Welcome to this afternoon's webinar, during which we'll focus on management incentive plans, or MIPs, and the effect of corporate actions on MIP awards and equity held by management. Andy, Chris, Ed, and myself have got a great deal of experience of navigating the potential pitfalls that can arise on transactions, and over the next 60 minutes we'll bring some clarity to this area. The session is very much designed to be a practical guide for employees and directors, and therefore please feel free to post any questions as we go along, and we'll try to answer as many as we can towards the end of the seminar. In terms of running order, I'll run through the impacts of certain corporate actions on MIP awards and consider how management's interests can be safeguarded. Andy will walk us through some of the key due diligence and tax risk issues to be aware of in relation to management shares. Ed will highlight the key valuation issues to bear in mind when a company is approaching a takeover. And Chris finally will explain how different types of consideration are taxed and the ability of shareholders to claim rollover relief. So the first point to consider is, what do we mean by a corporate action? The term has a very wide meaning, could encompass such things as listings, takeovers, demergers, rights issues, bonus issues, and stock splits. However, for the purposes of this webinar, we will be using the expression to mean IPOs, internal reorganisations, a change of control, or a demerger. So first, turning to IPOs. So what exactly is an IPO? Well, it's where a privately owned company either issues shares to the public as part of the share capital increase, or existing shareholders sell their shares in a public offering. The shares then become publicly traded on a market such as the London Stock Exchange or NASDAQ. The impact of an IPO on outstanding awards granted under a MIP can vary greatly from plan to plan and depending on the type of awards granted. It will usually depend upon whether the award vests only on an exit, which would look to align the vesting of management's awards with the interest of shareholders, or whether it vests subject to time and or performance-based conditions, in which case the IPO may have no impact. One point which we would always expect to see within MIP rules are provisions which allow the board to prevent participants selling some or all of their shares immediately after an IPO. Generally, investment banks would be concerned about key employees making windfall gains and leaving the company upon the IPO, and the employees selling large tranches of shares shortly after the listing, which would have a negative impact not only on the share price, but also on the public perception of the company. For example, it wouldn't send a very positive message to the market if the board sold all of its shares at the first opportunity. Therefore, we would generally expect some form of staggered exercise or vesting post-IPO, and a period during which the employees would be prohibited from selling their shares, which is commonly referred to as a lock-up period. In the lead-up to the IPO, shares are likely to become readily convertible assets, meaning that any tax liability that arises would need to be collected under the PAYE arrangements, which also means that there will be an employers and employees NIC liability. Most companies that list tend to implement a new suite of incentive plans that are tailored to the listed environment and drafted to comply with corporate governance best practice. Next, we turn to the key corporate actions for which is very common for a lot of our client base, and that of takeovers. Generally, when a listed or unlisted company is subject to a takeover, the impact on outstanding awards is the same. We would normally expect the term of the outstanding awards to be cut short. If the awards are granted under a MIP vest only on a takeover, then this will align the participants' interests with the sellers. However, if the awards are subject to time and or performance-based vesting, then the value that the participants will receive will depend upon the extent to which the awards have vested at completion. It is common, however, for MIP rules to give boards discretion to increase the proportion of awards that vest on a takeover. The key difference between the impact of a takeover of a listed rather than an unlisted company on outstanding awards is usually a timing point. The takeover of a listed company will usually have no impact on outstanding awards until the general offer has become unconditional or the scheme of arrangement has become effective. Whereas for an unlisted company, it's usual for all of the awards to be exercised at or immediately prior to completion, and for the employees to be a party to the share purchase agreement. This means that MIP participants will be shareholders only for a short period pre-completion. This is generally because the acquirer wants certainty around the fact that they can acquire 100% of the issued share capital. whereas participants in a MIP operated by a listed company will generally become shareholders post-completion, and the participants can either tender their shares pursuant to the general offer, or they'll be acquired by the purchaser pursuant to the squeeze-out provisions to the extent the purchaser is entitled to do so. The mechanism under a scheme of arrangement differs depending on the type of awards held by the participants and whether the awards vest on the sanctioning of the scheme or when it becomes effective. A less common but equally important corporate action is that of a demerger. Where a company is subject to a demerger, there are two general classes of employees. The first is those that remain with the company operating the MIP, and the second is those that leave to become employees of the demerged entity. But there is a subgroup of each, with those employees that are holding awards over shares and those that are actually holding shares in the company. I could devote a whole webinar to the impact of demergers on outstanding awards, but in the interests of time and your sanity, I will make a very few high-level points. A review of the MIP rules will be required to determine whether the awards will vest and the participants become a shareholder pre-demerger. In these circumstances, the participants should be protected in that they will acquire shares in both the original company and then subsequently in the demerged entity. However, if shares are not acquired pre-merger pursuant to the awards, then the value of the awards will fall due to the demerged entity leaving the group. There are ways to ensure that participants are not adversely affected by the demerger, such as adjusting the terms of awards post-demerger. However, no adjustment is permitted to tax-advantaged share plans. There could be a cash compensation payment linked to the vesting of the award, or potentially a cancellation and regrant. Demergers also have implications for shares held within the company's EBT, which will affect the ability of the trustee to satisfy outstanding awards. It also changes the company's equity dilution limits, and also this will need to be actively managed. The demerged entity will need to adopt its own suite of share plans post-demerger, as it will then be a standalone entity. Reorganisations. Reorganisations are increasingly common as companies look to ensure that their group structure is appropriate and tax efficient for their current circumstances. On an internal reorganisation where, for instance, a new topco is placed on top of the existing holding company over which the MIP awards have been granted, it would be usual for MIP rules to be drafted such that awards do not vest as a result of the reorganisation and instead provide the board with the power to subject existing awards to a compulsory rollover. The key is to ensure that MIP rules have not been drafted such that the placing of a new holding company is treated as a change of control, which would allow participants accelerated vesting, unless, of course, that was the agreed commercial position at the outset. Safeguarding management's awards is something that is not often considered until it's too late. Having worked on many transactions, I've seen numerous examples of where purchasers have tried to exert undue influence over the target company in order to reduce the overall costs of the acquisition, specifically around management incentives. The first point to note is who is responsible for operating the MIP, and where there's any discretion within the rules themselves, who's entitled to exercise it. Generally, for listed companies, any discretion is exercised by the REMCO, and for smaller, unlisted companies, it's generally the board. Issues can arise where, following the takeover, the purchaser's proxies control the board and the REMCO. This means that the purchaser will effectively be the body exercising any discretion under the MIP rules. I always advise companies to make clear within the MIP rules that the board or committee, as constituted prior to the takeover, is the relevant body to exercise discretion following the takeover. And this is a critical safeguard as the exercise of discretion to, for instance, increase the proportion of awards that vest or determine whether the performance conditions have been satisfied can have a substantial impact on the value that eventually flows through to management. It will also be via the exercise of discretion that the target company determines whether the participants are responsible for paying the employer's NIC, because often it's a determination by the board. Again, the target will want to ensure that these key decisions are taken by the board or REMCO as constituted prior to the takeover. Even when the MIP rules are quite explicit who has sole responsibility for the exercise of discretion, I've seen examples where purchasers have threatened REMCO with legal action if discretion is not exercised in a certain way, which results in additional awards vesting. However, there are ways to deal with this situation. Unfortunately, time doesn't allow us to get into the specifics at this point. Discretion to increase the proportion of outstanding awards that vest is more of an issue from the purchaser perspective for listed rather than unlisted companies. This is because the purchaser will calculate its offer price on a per-share basis after conducting due diligence to determine the proportion of awards that will vest. Therefore, any increase in the proportion of awards that vest will be a real and additional cost to the purchaser, whereas for unlisted companies, purchasers often fix the value of the company regardless of how many shares are in issue. Therefore, if the board of an unlisted company exercises its discretion to increase the proportion of awards that vest, it will simply mean that the value per share will reduce, and it's unlikely to result in any additional cost for the purchaser. So, just moving on to some points to note. When drafting any communications to MIP participants in the lead-up to any change of control, it's really important to keep them simple and brief. The more choices that are offered to participants, the greater chance of an error and the greater the administrative burden. One of the hardest issues on a transaction is ensuring that the tax treatment everybody's expecting is delivered and that structuring errors are not made such that the beneficial tax treatments are lost. Awards that are able to take advantage of the statutory tax reliefs have to comply with the strict letter of the law, and small errors or timing issues can cause tax relief to be lost. In order to avoid participants having to use their own resources to fund any exercise price, it's common for companies to put in place a cashless exercise facility to make it as easy as possible for participants. However, care is always needed when operating a cashless exercise facility, especially when dealing with an EMI scheme. If any loans are made to participants to allow for the exercise of options, then unless the loan is being made by the company within the employing group, then it's likely it may fall within the disguised rumination legislation, and adverse tax consequences may arise even if the loan is subsequently repaid. When operating a MIP in the lead-up to a corporate action, then there are many issues for the board and REMCO to consider. The board will need to determine whether they're in possession of price-sensitive information, or whether any grant would be breaching the market abuse regulations. In the lead-up to a takeover, the company's shares will generally increase in value. If the company is unlisted, then the substantial discounts of up to 75%, which are normally associated with minority holdings in enlisted companies, will start to fall away. And Ed will discuss this in more detail shortly. This increase in value can have significant knock-on implications for the number of shares that can fall within the prescribed limits of the MIP rules, and where options are granted under an EMI scheme, the exercise price is likely to significantly increase if it's to have market value exercise price. One trap that companies can fall into is granting EMI options shortly prior to a takeover. One of the key requirements under the EMI legislation is that the company cannot be a 51% subsidiary of another company, and importantly, there cannot be arrangements in existence by virtue of which the company could become a subsidiary or fall under such control. Therefore, by granting the EMI options prior to the takeover, it's possible that this condition could be breached and the options may not be qualifying options. There's always a question of whether a company can, and if so should, adopt a new share plan prior to a corporate action. The issue to consider is why the company is looking to implement a new plan now and whether the company qualifies if it is a tax-advantaged arrangement. For listed companies, new share plans and large awards can be seen as a poison pill. But that's not always the case, and often not the case for unlisted companies. Companies may look to adopt a new share plan or grant new awards on the basis the transaction has reminded the board that historic promises have not yet been delivered, or simply that the company is looking to lock in key management during this transitional period to protect the value of the business. The terms of any awards granted should be appropriate to the circumstances. Therefore, awards granted shortly pre-IPO should generally not be triggered by the IPO, and should continue to vest or be rolled over subject to the standard time and performance-based vesting conditions. As part of any due diligence process that the acquirer will conduct, full details of the target share plans and outstanding awards will need to be disclosed. Purchasers may question why plans or substantial awards are being granted prior to any transaction, and it's important that the target is able to justify the awards on commercial grounds. So that's all I was going to say about corporate actions. So now I'll hand over to Andy, who will talk to us about management shares and risk.
Thanks, Matthew. So I'm going to focus more on the issues for management shareholders with holdings that are not necessarily acquired under formal employee share schemes. This includes founders and long-term management shareholders. All of these individuals will have an expectation around their tax position, and in most cases this will be that gains are going to be subject to capital gains tax, and in many cases with the benefit of entrepreneurs relief. It's not uncommon that there becomes a risk that those expectations will not be met. There are often income tax risks for managers who have no expectation that income tax will apply. We have a huge list of relatively unique examples where income tax has unexpectedly become payable. Generally, the background to these risks will fall within one of three categories. The first category is bad housekeeping, where more effective administrative steps would have averted the risks. An example of a housekeeping risk is the entering into of Section 431 elections to disapply the restricted security rules. These are generally entered into for protective purposes whenever employees or directors acquire shares. A similar example is the registration of EMI share options with HMRC, which is an absolute requirement for EMI share options to achieve the tax benefits of EMI. Both of these are primarily administrative tasks, and often we come across clients who haven't done this. The second category of income tax risks covers those that are more technical but could have been avoided with more forethought. A common example is where a shareholder or a board have made promises to key staff but not formalised those arrangements. Based on such a promise or assurance, a key manager may be thinking as if they are a shareholder and expect the same tax treatment as the other shareholders, but in fact they will be subject to income tax. A similar example is if there is an agreement or desire to change the basis of sharing the proceeds of sale when the exit arises, which if not addressed properly can result in income tax charges. And the final category of income tax risk is where the income tax feels broadly unavoidable. An example is where circumstances of the transaction mean that EMI options need to be changed in such a way that making the change will cause them to cease to receive the EMI tax benefits. Similarly, changes to the share capital required on an exit could also give rise to income tax risk. In practice, any income tax risk that arises for management shareholders could be said to fall partly within all three of the categories that I have set out. And even where I have suggested that some income tax risks are unavoidable, it is still the case that there will always be ways to manage and mitigate the risk, and the opportunity to do this will be greater if addressed at an early point. It is very relevant who actually bears the income tax risk. If there is an income tax risk but it falls outside of PAYE and national insurance, this is a personal matter and not relevant to the purchaser. This then means that there's no need for different parties to agree on any technical analysis or valuation, and the manager can simply manage his or her own tax risk through self-assessment. In contrast, if the risk falls within PAYE and national insurance, the purchaser will consider it on due diligence and require indemnities and possibly some form of retention of proceeds. A purchaser may well take a conservative approach to the risk, and it's very difficult for a manager to influence or change this. Whether or not an income tax charge falls within PAYE and national insurance will depend normally on whether the shares are readily convertible assets, which is a term set out in tax legislation. Shares in listed companies will be readily convertible assets, but in private companies, the test considers whether there are arrangements in existence or likely to come into existence by which the shareholders can receive money for their shares. For a private company with no market for its shares, one can see that as the company moves towards a transaction, a point will arise where it would be said that the trading arrangements are likely to come into existence. If the proposed transaction is an IPO, HMRC would generally say that the appointment of a broker is the signpost that trading arrangements are now likely to come into existence. For a company sale, there is less clear practice, but entering into exclusivity or signing a letter of intent are steps which may be shown to demonstrate that trading arrangements are now likely to come into existence. Whilst I have identified other circumstances on the slide under which PAYE and national insurance will apply, it is often the case that a private company's shares will become readily convertible as steps are taken towards a transaction, and this will in turn shift the income tax risk for the manager into the pay-as-you-earn and national insurance regime. Once again, this highlights the benefits in addressing the income tax risks early. It's also important to note that PAYE and national insurance obligations are limited to a company's best estimate of value. Therefore, it should generally not be necessary to enter into debates with a purchaser on valuation, unless the purchaser is contending that the company has not applied its best estimate of value. Ed is discussing valuation later in this webinar. So, putting together these income tax points that I've raised, I've set out on this slide some key areas that often get raised on a due diligence, where good housekeeping would allow a company to easily address the risk. I've mentioned Section 431 elections above, and it's good for a company to be able to produce these on due diligence. In relation to EMI, as well as demonstrating that options have been registered with HMRC, it's also valuable to have sought an advanced assurance clearance from HMRC that the company met the qualifying requirements to grant EMI options. The EMI scheme also needs to contain the requisite requirements relating to options, and this is a matter for care when the scheme is implemented. There is a requirement to submit annual returns to HMRC of share schemes and share transactions, and a purchaser may request evidence that the reports have been prepared and submitted. It's also valuable to be able to demonstrate how valuations have been carried out in relation to shares and share transactions, and where appropriate, agreed with HMRC. So where the income tax risks are appropriately addressed and the manager is in the expected position of being subject to capital gains tax in relation to their shares, there is also the question as to whether the disposal will qualify for entrepreneur's relief. While the detail of the entrepreneur's relief conditions are complex, the headline position is that there are just 3 requirements that need to be met. These requirements, set out in this slide, are the employment requirement, that the shareholder is an employee or director of a group company, the personal company requirement, which means that the shareholder holds 5% of the ordinary share capital and can exercise 5% of the votes by virtue of that ordinary shareholding, and the trading company requirement, which means that the company is a trading company or the holding company of a trading group. These conditions must be met for a year prior to the date on which the shares are sold. The complexity that sits behind these conditions means that it is not uncommon for entrepreneur's relief to not be available where there is a clear expectation that it would be the case. As with the income tax risks, there is an extensive list of examples where this has arisen, but I've set out here some of the key risk areas. A key source of risk is that there is a specific definition for tax purposes of ordinary share, and all other shares are consequently not ordinary shares. A share is not necessarily an ordinary share just because it's defined as such in the company's Articles of Association. The shareholder needs to have 5% of the ordinary share capital, and therefore if his shares are not ordinary shares under the tax definition, he won't meet the requirement. On the other hand, if an investor holds shares that are considered to be preference shares and not ordinary shares, but those shares actually fall within the definition of ordinary shares, they may cause the manager's shareholding to be less than 5% of the total, effectively diluting the manager's ordinary shareholding. If a manager holds loan notes or preference shares, those loan notes or preference shares may benefit from entrepreneur's relief, but only if they are issued in the same company as the ordinary shares are held. Loan notes in particular are often held in a different group company, which may mean that entrepreneur's relief is not available when those loan notes are disposed of. Sometimes management shares are created as non-voting shares, and this will inevitably mean that entrepreneur's relief is not available. Management can also be diluted in any number of circumstances on a transaction, such as by the exercise of employee share options or investor warrants. On the face of it, dilution that takes a manager's shareholding below 5% will mean that the manager does not qualify for entrepreneur's relief. But HMRC's approach is that dilution arising on the same day that the shares are sold will not be treated as taking the manager's shareholding below 5%. Therefore, the mechanics of a transaction and the date of the exercise of the option and the date of the entering into the sale and purchase agreement will be absolutely crucial in determining whether dilution impacts on a manager's entrepreneur's relief position, and this needs to be considered very carefully based on the specific facts. Sometimes there are investment agreements that give specific protections to investors in the event of a breach of specific covenants, and sometimes these protections can be structured in a way that means that management share voting rights are unclear. This type of commercial agreement can normally be structured to minimise the risk to entrepreneurs' relief, but this needs to be considered when the agreements are entered into. Some management teams hold shares through special purpose vehicles. Historically, this sometimes resulted in a more attractive entrepreneurs' relief outcome for the managers, but these rules have been changed so that this is no longer the case. However, where these structures exist, they need to be considered in the light of the specific joint venture rules. Other areas that we've considered recently at BDO are companies retaining significant profits and in some cases investing those profits, which creates a risk to the company's status as a trading company or the holding company of a trading group, which is one of the risks on the previous slide. Also, spouse transfers have been undertaken, which means that as well as the conditions on the previous slide needing to be met in relation to the spouse who's received the transfer of shares, including that spouse being an employee or a director in the company, those conditions need to be met for a year prior to the disposal in order for entrepreneurs' relief to be available. Finally, it's important to note that managers who are resident or employed outside of the UK mean that all of these issues need to be considered in those other jurisdictions. If there are mobile employees who may be taxable in more than one jurisdiction, it's necessary to consider the interaction between the different jurisdictions, which adds even further complexity. A common example is US citizens who are resident and taxable in the UK and therefore taxable in both jurisdictions. Much of the analysis relating to the UK, such as entrepreneurs' relief, ceases to be relevant since the US capital gains tax rates are higher and the individual will in effect be paying capital gains tax at the highest rates. I've set out on the slide a number of specific technical points that would need to be navigated in the US in this case. Where there are income tax charges that I've considered would arise in the UK, as I spoke about earlier, the amount subject to income tax would generally be set against any amounts that are subject to capital gains tax in the UK, but it's less clear that these amounts will be set off against capital gains tax arising in other jurisdictions. Also on this slide, and specifically in relation to the US, Section 409A is a very common headache that employee shareholders and option holders have to deal with, that often applies because the US take a different approach to valuation than the UK. Section 280G is another provision which is similarly punitive in the US, which applies where employees are receiving material amounts, for example through share option gains, that only arise on an exit event. In this case, it's often possible to mitigate the tax risk by seeking shareholder approvals. Consistent with most of the other points that I've highlighted above, the earlier these points are raised and identified, the easier it is to address them. So we've already mentioned the importance of share valuations a number of times, and now Ed is going to give us a bit more detail around that.
Thank you, Andy, and good afternoon, everyone. So when we talk about valuations of shares issued to employees, what we're really trying to resolve is whether the price paid represents market value. Because if the price is less than market value, there are likely to be tax consequences for the employee and potentially for the company. And transactions such as a sale or an IPO create some additional issues because, firstly, they clearly shed light on what the value of the company might be. And secondly, they can also be a trigger for HMRC to start making inquiries. So I'm going to explain these various issues with the help of a handy timeline. And I've highlighted above the line a couple of key dates. The first one is the 31st of March 2016, which is the date when HMRC withdrew their post-transaction valuation check service. Now this is very important because valuations can never be exact. There's always a range of possible answers, and therefore getting certainty in the form of HMRC approval is really valuable. The best type of certainty you can get is a pre-transaction agreement, which is available on approved share schemes such as EMI, CSOP and ESS, because then you actually have the agreement before you issue the shares. The next best type of certainty, which was still very helpful, used to be the post-transaction agreement, which prevented hindsight colouring HMRC's judgment. However, as I said, this service is no longer available and hasn't been for a while. So you are really left with making sure you document robust valuation conclusions at the date of issue, which can then be used in defence of the HMRC challenge at a later date. The second key date I've highlighted is the sale or IPO date, which I've assumed for the purposes of today is going to be in about 6 months' time. Then below the timeline, I've looked at 3 different time periods during which shares might be issued. I've called the first period historic awards, which take place sufficiently prior to the sale or IPO for the exit value to have limited relevance. However, it's still likely that those historic share issues will be scrutinised as part of any due diligence work, and also by HMRC once the transaction has been announced. The second period when shares might be issued, and we often see a rush to issue shares at this stage, is once the process has actually commenced. And during this phase, HMRC would typically expect to see any valuation based on the expected sale or IPO price, less a discount for the uncertainty that the transaction may not go ahead. Now, the size of that discount will depend on how far through the process you are and when the shares are issued. So it makes sense to issue as early as possible during this phase to maximise any discount. Finally, the last phase is at or following the transaction when shares are typically issued to continuing management. At this point, the actual share price will be known, of course, and will clearly set a benchmark for future share issues. Although in the case of a sale, you would typically still apply a significant minority discount for employee shares, reflecting a lack of control and the fact that the next liquidity event may still be some way off. So just to sum up on valuation, the 2 key points are whenever shares are issued to employees, it's important to have a robust valuation supporting the price, and ideally to have HMRC agreement wherever possible. And secondly, if shares are being issued in the run-up to a sale or IPO, then the earlier the better to maximise the discount. That's all I wanted to say on valuations. Up to now, Matthew, Andy and I have been talking mostly about tax issues in the run-up to a transaction. I'm now going to hand over to Chris, who is going to speak about the tax treatment of the takeover itself.
Thank you very much, Ed. I'm going to focus on the tax implications for management who receive proceeds on, in particular, a takeover transaction. So the most common examples we see are buyouts funded by private equity, but much of this will also apply to other types of takeover as well. I'm going to look at each type of consideration that management shareholders might typically receive for their shares, namely cash, earn-outs and other types of deferred consideration, and exchanges into new shares or loan notes. I should also touch briefly on areas where clearances can be received from HMRC to provide additional certainty on the tax treatment, and then look at the new shares that management typically subscribe for in a BDO or a new acquirer company. So starting with cash, the proceeds of the disposal of shares would, as Andy and Matthew have both mentioned, be treated as a capital gain, provided that certain anti-avoidance rules don't apply to recharacterise these amounts as income. These rules exist precisely because it's much more advantageous in tax terms to receive capital as opposed to income. There are 2 main sets of anti-avoidance rules here, which relate to employment tax and dividend tax, respectively. In terms of employment income, the risk is that charges arise under the employment-related securities rules that we've heard about already. These can apply in a range of situations and are best managed when the shares are originally acquired, and certainly in any event, well before a transaction occurs. In relation to process, as Andy mentioned, these charges will normally be quantified on a due diligence exercise because of the PAYE and NIC liabilities associated with them. The second set of provisions are the transactions and securities rules, which can treat the proceeds as a dividend distribution subject to income tax. Now, this is solely a self-assessment matter, so management are likely to have to ask their own advisors to consider these risks as opposed to the company's advisors. The rules are complex, but it's possible to seek clearance from HMRC in advance that these rules do not apply. HMRC will grant this clearance if they are satisfied that there is no tax avoidance motive in the transaction. So it will be necessary to provide reasonably full details of the transaction steps before clearance can be sought. This is a statutory clearance, so HMRC are obliged to respond to it, but have 30 days to do so. It's therefore important that this is factored into the transaction timetable. Assuming that neither of these anti-avoidance rules apply, the cash proceeds will be subject to capital gains tax, and potentially reliefs such as entrepreneurs relief and EIS will then reduce the amount of tax ultimately payable. Clearly, management as individuals will want to understand the amount of tax they're going to pay, but it's also important in terms of the deal mechanics as a whole, because it will affect the amount that management shareholders have available to reinvest into the deal, which is often an important commercial issue. The next type of consideration also comprises cash, but is subject to a delay in payment. Deal consideration will often comprise a mixture of upfront cash, deferred cash, and earn-outs, each of which has its own tax treatment. Upfront cash is taxed in the way that I've just described. It's important to note that this tax is payable in the tax return in the year of disposal. So for a sale closing today, tax will be payable in January 2019. This tax charge would also potentially qualify for CGT relief, such as entrepreneurs relief. The second type of cash payment is a fixed amount, but is not payable for a period of time. This amount will also be taxed in the year of the disposal, not in the year of the receipt, if this is later. The feature that determines this treatment is that the amount is ascertainable at the date of the disposal. Whilst this does appear to result in an acceleration of tax, the advantage is that such amounts do potentially qualify for entrepreneurs relief. There is a different position, however, for amounts that are unascertainable at the date of disposal. The typical case here will be an earn-out payment that varies according to post-deal EBITDA or profits or similar measure. Here, the consideration for the shares is the earn-out right itself. So this right is treated as a separate asset, and its expected value is calculated and taxed in the year of the disposal. This means, in turn, that this value is also eligible for entrepreneurs relief. However, when the earn-out finally pays out in cash, this is treated as a disposal of that separate asset, not the original shares. Any amount received that is over and above the expected value that's already been taxed will be taxed in the year of the receipt. So there is a cash flow advantage in this case, but the downside is that the subsequent payment is not eligible for entrepreneurs relief. It would therefore be taxable at 20% normally as opposed to 10%. The expected value of the earn-out right is subjective insofar as it depends on an assessment of how likely it is that earn-out targets will be met. For any person eligible for entrepreneurs relief, they might want to argue for a higher value, whereas other shareholders may wish to argue for a lower value and defer some of their tax. In the event that different shareholders take different views on valuation, that would make it more difficult to defend in the event of HMRC challenge, so agreeing a consistent basis here is clearly preferable. There is a concern with any earn-out that HMRC may seek to recharacterise the payments not as the deferred proceeds of sale, but rather as part of an ongoing remuneration scheme for management shareholders. The effect of this recharacterisation would be that amounts would be subject to income tax as opposed to CGT. Obtaining certainty of treatment is often difficult here. HMRC operate a balance of indicators approach. In other words, they set out a series of factors that suggest capital or income treatment, and then you weigh these in the balance. In broad terms, HMRC will want to know whether the value of the earn-out reflects the value of the shares given up, or whether there's an element of disguised remuneration, such as future bonuses, wrapped up into that earn-out payment. Among the indicators, it's important to consider in particular the nature of any performance conditions, any requirements for ongoing employment, and whether any other shareholders, non-management shareholders, are receiving a comparable package of consideration for their shares. In practice, it's common that some factors will point to income and some to capital, and a judgment will therefore need to be made, not only by shareholders themselves, but by the company, that may have to account for PAYE or NIC if the payments are challenged as remuneration. It may be possible to seek a non-statutory clearance from HMRC, although HMRC will only give a definitive response to these where they perceive there to be material uncertainty in the analysis. So these clearances can be a little bit more speculative than the clearances I referred to earlier. As well as receiving cash, it's normal in most private equity transactions for management to invest in the new company alongside the institutional investor. This raises capital and aligns the interests of various parties in the transaction. In some cases, this is achieved by reinvestment of cash proceeds. So a full CGT liability arises, and management agree to invest usually a proportion of their net of tax proceeds. The alternative approach is for management to roll over. This normally seeks to ensure that no CGT liability arises on the shares exchanged for new shares or loan notes. This rollover treatment effectively pretends that no disposal was made and the new shares or loan notes stand in the shoes of the old ones. The result is that any CGT liability is deferred until the new investment is eventually cashed out. In order for this treatment to apply, there are various technical requirements to be met, but for many shareholders there's an additional requirement that the transaction does not have a tax avoidance motive. Again, it's possible to seek advanced HMRC clearance in this regard, and this can be sought as part of the same clearance process as the transaction securities clearance I mentioned earlier, with the same impact on deal timing. Once the concept of rollover is well known, it remains important that the mechanics are done correctly in order for relief to be guaranteed. In particular, where there are multiple rollovers via a series of new codes, as is usual in private equity, these exchanges must be on a stage-by-stage basis, and at each stage the books and records of the company must be written up to ensure that the shareholders have beneficial ownership at each stage. Normally, these multiple exchanges are effected by way of loan notes to avoid triggering multiple stamp duty liabilities. This does, however, technically mean that any qualification per ER does not track through to the new shares. The 12-month clock for qualification per ER will therefore normally restart at the date of the deal. Finally, on rollovers, this aspect becomes notably more complicated when the management team is international. Similar rollover treatment is often possible in other jurisdictions, such as the US, as Andy mentioned earlier, but the conditions and preferred mechanics tend to differ. It's therefore extremely difficult to accommodate all shareholders in this regard without incurring a high degree of complexity. Now, once the rollover or reinvestment is complete, management will hold shares in the new acquiring company. Typically, management will have two separate holdings in NewCo, an institutional strip and sweet equity. The institutional strip is likely to comprise a small portion of shares and a greater proportion of debt-like instruments, such as loan notes or preference shares. These instruments will normally be funded by the rollover and will reflect the funding split of the PE house, so that management and private equity investors are aligned. Sweet equity will normally comprise a separate class of ordinary shares with leaver provisions, vesting and performance conditions attached to them. This will provide an ongoing incentive for management and may go to a much wider class of employees as well. There are two key areas to consider in respect of these shares. First, it's important to assess whether the right amounts are paid for them in order to ensure there is no upfront income tax charge, as Ed has explained. This can be assessed by reference to the safe harbour provisions in the Memorandum of Understanding agreed between HMRC and the British Venture Capitalists Association, or if you're not within that safe harbour, then by undertaking a valuation in the way that Ed described. The second area is to seek to ensure that the most advantageous tax treatment is available on disposal, and this usually means entrepreneurs relief for most management teams. And this also means falling outside the employment-related securities rules. Whilst these are reasonably well-trodden paths, no tax discussion is complete nowadays without mention of the current environment in relation to perceived tax avoidance. Sensible tax structuring has long been part and parcel of doing a transaction, not least to meet the expectations of the parties and achieve the commercial aims. This still all holds true, I think, but the new rules on the disclosure of tax avoidance schemes and the general anti-abuse rule, and the range of penalty regimes applying to both taxpayers and tax advisors, this must all be taken into account in considering what is and isn't possible in terms of achieving the desired tax result, and factored into the expectations of the parties at an early stage. On that upbeat note, I will hand over to Matthew to wrap up for today.
Okay, thank you, Chris. So I've got a lot to get through in 45, 50 minutes. So in summary, we've seen that different corporate actions can have very different impacts on outstanding awards, and therefore getting advice at the earliest possible time is critical to ensure that pitfalls don't cause any beneficial tax arrangements to be lost. And I also pointed out that there are simple ways to protect key management's interests on a corporate action. Andy reminded us that issues or risks relating to income tax or the availability of entrepreneurs relief are much easier dealt with at an earlier point rather than close to the transaction, and that ensuring that you're on top of administration of the MIP and able to identify potential due diligence risks are an easy way to minimise issues on a transaction that can result in a price chip. Ed mentioned that whenever there's shares issued to employees, it's important that you have a robust valuation supporting the price, an agreement with the revenue where possible, and also where shares are being issued and they're up to sale or an IPO, then the earlier the better to maximise the discount. And also Chris explained that negotiations on how to structure the form of consideration for a takeover can have a material effect on the tax payable by management shareholders, and that complexity of the rules that we've covered today mean that share issues are likely to feature heavily in any transaction structuring. So we've covered quite a lot in a relatively short period, but I know that we've received a few questions which we'll endeavour to answer. The first one is on valuations, and the question is, if I've agreed an EMI valuation with HMRC, but I've received an offer for the company before the options have been issued, do I need to tell them about it? And I think that's one for Ed.
Yes, thank you, Matthew. So the short answer to that question is yes. So if you've ever received one of these agreement letters from HMRC, typically it will say that the agreement stands for 60 days. So that gives you a couple of months in order to issue options. But it also says, look, if there are any significant events between now and when you issue the shares or the options, then you need to let us know, and it gives a list of potential events, including an offer for the company. So the reality is, although telling them about it may lead to a higher valuation, if you don't tell them about it, then your agreement isn't really worth the paper it's written on, unfortunately. So it's very much an area where you do need to disclose.
Okay, we've got another question here. Thank you, Ed. In circumstances where an EMI is not an option, what other employee management incentives can be used? And I guess actually that we'd need to kind of consider why EMI is not applicable. So it may well be that the company doesn't qualify, for instance, because it has more than 250 employees, or that the gross assets are more than 30 million, or it falls down on the excluded activities. And it may be possible that the company does qualify for a company share option plan, but the limits are lower. Quite a lot of companies, both mainly listed companies, in particular on AIM, have implemented joint ownership plans, and that's where there's a sort of split interest scheme where the management and a trust or third party, generally a trustee, will subscribe for shares, and the management have the upside on the shares, and the trust has the inherent value, and that can sort of replicate to a certain extent a market value option, but taxed as capital rather than as income. So that can be pretty tax efficient. So I have another question that's come in, is how common is it for management to seek clearances, and are they ever refused? Chris, do you want to pick up that one?
So it is overwhelmingly normal for management teams to seek the statutory clearances that I referred to. And I think from the point of view of them as individuals, there are very few circumstances in life where you get certainty of tax treatment. So why would you not try and secure that if you could? Most investors who do UK deals are sort of sympathetic to that requirement. Clearly, timing sometimes becomes a bone of contention. At which point there are difficult discussions about how risky these sorts of things are, and what's the risk that the clearance will be refused. And I think that very much depends on the type of transaction and the role of the shareholder. So very broadly speaking, a small minority shareholder is unlikely to have clearance refused. The more influential you are, or a group of individuals are within the transaction, the greater the risk. And it is possible to have clearance received successfully for some individuals, but not for others, which I hope answers that question.
Okay, sorry, there's another question that's come in. Is there any way of issuing shares to management with restricted rights, i.e. lesser rights than for founder shares, but which still qualify for entrepreneurs relief? Andy, do you want to pick that up?
Yes, so the simple answer to the question is yes. So there are lots of companies out there with different classes of shares with different rights, and the entrepreneurs relief requirements are exactly as set out in the slide I talked through. So the 5% requirement relates to the ordinary share capital, which is measured by the nominal value of the shares, and also the voting rights. And therefore, if you take one example, there are lots of businesses out there that have growth shares held by management that have restricted capital rights, where the capital rights only come into play over and above a given equity hurdle. And that would be an example where those shares can still qualify for entrepreneurs relief because they meet the 5% condition, but they don't always qualify for 5% of the capital, depending on what the level of exit is. So the answer is yes. Care needs to be taken to make sure that if you're looking at share rights, that you are doing things for commercial purposes, and then you're not seeking to avoid tax. But if you're implementing management equity, then you can normally navigate that requirement.
So we've got another question. So questions come in. Is it the case that entrepreneurs relief is under some circumstances available for shares awarded under an EMI scheme where employees or officers have less than 5% of the ordinary shares, perhaps where the scheme was put in place after a certain date? The answer to that is yes. For entrepreneurs relief in relation to EMI, that if an option is granted to employees where they satisfy the other conditions, then provided that there is more than 12 months from the date in which the EMI option is granted to the date on which the shares are sold, then the individual would qualify for entrepreneurs relief and therefore 10% on any growth in value, even though that their option may be over less than 5% of the issued share capital. So it's the actual period over which the shares are under option is treated as part of the holding period for entrepreneurs relief, which is quite unusual.
So we've got another one that's just popped up. So this question says, if I hold 5% of the shares in a company and meet the entrepreneurs relief conditions, and then I exchange my shares for less than 5% in another company, will I qualify for entrepreneurs relief in relation to the shares in the second company? And the straight and simple answer to that is no. Once I've gone below 5%, then I won't meet the requirements in relation to the second company, and then when I sell the shares in the second company, I won't meet the entrepreneurs relief requirements. I guess if this were a longer webinar, one of the things that we would have covered was the fact that you can make elections to crystallise your capital gains disposal on that exchange of shares from one company to another company. So in that situation, you may say, well, I'm going to crystallise my 10% tax, pay tax on the exchange of my shares, which means that I'm effectively paying potentially a dry tax charge, and if the value of the second company then falls, then I've expended tax that I may not get back. But it does give me the opportunity to lock in my entrepreneurs relief before I cease to qualify.
Okay, so I think we've pretty much we've run out of time, but if anyone has any additional questions which we haven't answered during the session, our contact details are at the back of the slide pack, and we'd be very happy to discuss these with you. So all that's left for me to do is to thank you very much for attending.